Okay. Good evening, everybody, guys. Now, it says dollars for lunch because if you're in the US, it's lunchtime, right? So it hasn't changed to Trade-A-Thon for the evenings, or pounds for dinner, or euros for dinner. I don't know what we're going to end up calling it. But this is our Trade-A-Thon, right? I've shared the love this evening, and I've shared this into some of the other groups, not all the groups, just some of the groups. So we're going to have a few more people joining us this evening for this particular broadcast. Now, Trade-A-Thons are some of my favorite events, shows across the board, because this is an opportunity for us to be a little bit more relaxed. And I have shared this obviously into the free environments, but this is where we kind of have some opportunity to take time, answer questions, go through the markets. And for this evening, obviously we have a big event, right? We've got interest rate announcements. The ripple effect will be felt across the world. If you have an F&B, credit card, if you've got a bond on your home, if you've got a vehicle finance in your car, most people around the world, or specifically in Southern Africa today, should receive some sort of notification from their bank saying, hey, interest rates have changed. You are going to be paying more monthly for your car or your home. And you would have got that notification today. So if you didn't go check in your inbox, you might have seen that. If you got a variable interest rate, you got a fixed interest rate, so be it. So there's quite a big knock-on effect around the world. And I thought this evening we're going to do two things. So first things first, if you're joining us from wherever in the world you're joining us, just a massive welcome to you. I can see Lee's in the house, Fuad, Obed, the beautiful Miss Marsha Bart, even though he's there and she has some personal time doing her own things there. She's joining us anyway. And we got Biso in the house. We got Rishmi in the house, as well as Fabian. Okay, so what we're going to be doing tonight is I'm going to take you through the release, right? The data is going to come out in the next 12 minutes and 50 seconds. Then we have about 25 to 30 minutes before we get the press conference, right? And the press conference is really just as important, almost if not more important than the actual data itself. You may say, Dane, but how does that work? Why do you say that? For those of you who've been with us, part of earnings reports, right? These also tend to happen pretty late in the evening, South African time. Earnings reports have two sets of info, right? The first set of info is, what is the data? What is the EPS, earning per share? What is the company spending on R&D? What is their, current expectation for the forecast? That's just the raw data side. The most important part of that, or what I generally think as the most important part, is once the earnings have been released, there's generally a call with the shareholders, the stakeholders, where they explain, okay, this is the state of the company. This is where we're going. This is the issues we're having. This is what we expect. And we call this forward guidance, right? And that's just as important as the numbers. The numbers the markets have priced in. The markets have, from my belief and standpoint right now, the markets have priced in that interest rates may remain unchanged. We may not get an interest rate hike today, but the markets are looking at the forward guidance, what may end up coming. And that's what we're going to get at 8:30. Now, between 8 o'clock and 8:30, I'm going to take you guys through a little bit of a deep dive. Often we speak about interest rate rising. We speak about, this is good for the dollar, bad for the stock markets. And I get a lot of questions around that, right? A lot of people may just assume what I'm saying is true, or try and go and find the info out there. And I want to take you through my process of understanding and how I go ahead and look at things like this, right? Give you an, sort of put you in my shoes. And it's not this fancy, Googling, give me an inverse, overlaid report of S&P 500 versus the dollar index versus interest rates. I prefer to go ahead and do it myself, to go and find, is there some commonalities? Is there some clues there? So I've gone ahead and done that. We're going to do a deep dive on the S&P 500. We're going to do a deep dive of all the interest rate decreases, the interest rate bottoms. And then every time they raise the interest rate, what happened to the dollar, right? What happened to the stock market? Because these are important things we need to understand moving forward. Some of the biggest investors in the world, right? Both investors, the most brilliant minds in business, in politics, in economics, all say the same thing, is that what has happened before is bound to repeat itself. Even though we think we're living in unprecedented times, which we kind of are, even though we think that something like this has never happened in the world, which it probably hasn't, there's some certain traits and trademarks of things that have happened in the past that are similar and will repeat themselves, right? Things repeat themselves. It's the reality of things. Most of you understand this, that these things do repeat themselves, okay? And it's about understanding the past to look at the commonalities to repeat the future, right? If it Evade Tech is saying FOMC predictions. Well, we're going to go through that quickly, and it's going to be a very, very simple one, right? So let's go into the data. Let's look at the charts, and let's look at why in particular this particular set of data that we've got, and we're referring to the consumer inflation, the producer inflation that we received today and yesterday. These numbers should have given us different results in the markets, and this is why I've particularly looking at the CPI coming out yesterday and what I know should be true about the markets and how it's reacted, why there's a little bit of a pause, a little bit of a mismatch from a data perspective on what should be happening and what is happening, right? So let's quickly dive into that, and let's go back, right? We're going to dive into the deep dive of interest rates and how this all works in a way I think you guys will enjoy, and I'd love to know your feedback once we get through that. If you love it, if you understand it, if you don't, you let me know when we get there. So let's quickly dive in and just have a look at the economic calendar of what we can expect to see and how you can potentially set yourself up for trading this particular event. So first things first, and I think goes without saying, whether it be non-farm payrolls, whether it be CPI, PPI, interest rates, GDP data releases, all of these are big fundamental data releases, right? High impact, high movements. And so it is important for you to protect your trading accounts, right? In a move like this, and I just want to bring this into perspective because I think, social media and I believe as traders, there's been a big injustice that's happened, over the past couple of years where some of these events are hyped up as the be all end all of trading, right? And I want to get you guys' opinion on this. I really want to know what you guys think about this. Do you think this is true? Not true, right? People hype up these events. You've got to come trade the NFP, the CPI, PPI, whatever the case may be. But if you have a look at those pip movements, if you have a look at the range, let's look at CPI, let's look at NFP, let's look at all these things, right? If you look at those pip movements, we're not talking about 10, 15,000 pips in an hour to justify, the whole week's worth of moves in one particular session. We're talking about 1,500, 2,000, 3,000 pips, right? So we're not talking about unprecedented amounts of moves, but we do add in a bunch of volatility and a bunch of complications. From my perspective, and if I look at my trading history, on those days are where I sometimes take a hit or I get to break even, or my ROI tends to take a little bit of a pause. So what I need you to understand is that trading these high impact news events, yes, it's hype, it's news. Rather utilize this as an opportunity to gain, not necessarily financial on your trading accounts, and yes, place some trades, great, but try and understand something a little bit more about the markets in those events and what you did yesterday. I just want to add that because I feel that traders have hyped these things up that you need to come and trade an event that, quite honestly, most pros out there sit back and observe, look at, and then make decisions there on after. They see what the general market is doing, they look at the data, they read the data, they go through the data, rather than having a simple number chucked out that generally has a lot more info behind it and you're just taking a guess, right? So I just want to state that again, these things, are not about predicting the market. We can look at past data, what's happened along those lines, and have a certain outcome or percentage of likelihood that this will happen. But it's impossible to, roll, rubber golden, glass ball and predict. A lot of people ask, how do I see the market so accurately? How do I call out trades within minutes of precision of entries and exits? It's coming down to, before I gave that trade out, I spent 3 hours looking at that chart, looking at past history, etc. So I just want to state that and put that out there. So when it comes to the data, right, let's talk about the interest rate decision, right? Interest rate decisions coming out in about 5 minutes, expected to remain at 5.25% base interest rate, right? Now, where we have some issues from this and from a data perspective, let's just go on to US30, right? Here's US30. And I'm just simply looking at US30 on a 15-minute time frame. And I'm going back to yesterday, right? Yesterday's CPI data showed us that inflation is coming down. Good for the stock markets, bad for the dollar. And initially we see the reaction was positive. Remember, I gave a good explanation on most groups as well as Premium Plus. If we see a number beat, that 4% mark, we could see a bullish US30, US 100, even gold to that to a further extent. What we saw happening then is low inflation, markets pushed, but the low inflation, the reason markets pushed is it's a dual thing. First thing is that inflation is coming down, and when we go into the data, once we get the number, you'll see why this is good for stock markets and bad for the dollar in terms of raising interest rates or lowering interest rates. So I'll explain that in fuller detail. But in essence, this kind of reacted closer to what we expect besides the whipsaw, right? Then if you have a look at today, this is where it gets a little bit curious, right? The PPI, Producers Price Inflation, or PPI, Producers Price Index, came out under expectation, right? So meaning inflation was lowering faster than anybody expected. This is a good thing for the stock markets, that the interest rate this afternoon or this evening should remain flat, or at least start to taper off. And what we're looking for is Powell at 8:30 to say, you know what, things are coming in order. There's still a long way to go, but things are in line. This is what the stock market needs to make a bounce back and make a massive bull move. So what I'm expecting this evening, if things are supposed to react in line and equal, and what we've been looking for months, is that at this moment right here, we are looking that if interest rates are not raised, right, if we remain at that 5.25%, we're looking for buy activity off of this level, right? Now, again, for those of you who don't just want to jump in and just obviously, you know, bite the bullets and just jump into something, it's going to be a fairly simple trade in the sense that all we're going to do is just simply look at this little rising structure here, and we just want US City to beat this rising structure. Now, again, if you're on a different broker, and that's why, you know, I prefer for all my clients and all my people to be in the same environment, you may see different pricing, you may see different structures, right? That's just the reality of different instruments housed in different places. But should we receive that interest remains, the interest announcement remains flat, for me to see a normal market and to restore faith in the fact of the balance of things, I'd want to see some sort of bull activity here. And again, this is coming in line with where the dollar is currently sitting, right? Dollar index, right? We've seen starting to taper off. This is on a daily time frame, right? That's looking at the CPI from yesterday, and the PPI from today has ultimately broken a massive long-term structure on the dollar. Dollar has started to move into bull territory that has broken the pivot point for the dollar, right? That new bear territory is good for stock markets, good for US 30, good for US 100. The reason why I'm optimistic about a bull break here is this complete pullback outside of this zone. Now again, 15 minutes, 5 minutes US 30, we've got this massive bull market, we've pulled back. I believe this is a bear trap, right? There's a bear trap on US 30, getting a bunch of people short, and all we're going to see this evening is that markets go back into bull territory again. This is going to come provided Powell is not hawkish on the market, doesn't cross angry and say we'll do whatever it takes, we'll smash the markets, we'll beat it apart, we'll use every tool at our disposal to bring inflation down. Because remember, in order for the Federal Reserve to bring inflation down, they essentially need to beat down the US market. They need to cool off a good market. They need more and more people to be unemployed. They need the job market to be slightly worse. That's what they need to do, right, in order to beat inflation. So what I'm looking for this evening is if we see a pop here through the 341, I could almost say 341 flat mark, that will be a sign we could be moving into bull territory. However, as we've seen with previous interest rate announcements, these numbers might come out, and then, you know, the first candle, the first two candles might kind of just, you know, sideways market here, just as we've seen. But ultimately what we're looking for is a push. For me as a trader, if you're asking me, Dan, okay, ignore all the hype, ignore all the fuss, what am I looking for? Very, very clean, very, very simple, right? What I'm looking for is a win for tonight. I don't care about anything in this range. I don't care about anything, you know, on US 30. I don't care about anything between this 34200 flat mark and where we are now. I care nothing for this range. Anything 2000 pips in this range, I care nothing for. I care about markets above that, and I care for markets below that. If after the Federal Reserve, after Powell speaks, markets are below this, we have a serious imbalance in markets, and then we're going to have to seriously look at long-term short opportunities, right? So let's get in it. We should be a couple seconds away from that interest rate announcement. So let's give it. So they've actually dropped the interest rate, This is going to be good for US 30. but we're seeing it come in bad. Let's just have a look here. This should be good for the US 30, right? And the reason why I'm a little bit worried that we're seeing a negative here, if we have a look at the interest rates announcement, it was 5.25 that actually dropped interest rates, right? So I would be precautionary trying to buy into US 30 now, but because we're seeing US 30 fall, right, in this particular moment, tells me there's massive issues here. US 100 also falling, and as well, let's have a look if gold is falling too. So dropping interest rates, and this is why we're going to go through the data in a second. Historically, dropping interest rates has been bad for the dollar throughout history, right? Because it does a couple things. Less people want to invest in the US economy because there's lower yields, lower dividends in terms of actual dollar. But more than that is that it's just not as investable, right? When interest rates start to get dropped, this is where stock markets and the economies perform. S&P 500, NASDAQ, Dow Jones, all these indices have performed massively in the past when the interest rate is either dropped or lowered. So the fact that we're seeing interest rates have dropped, unless it's the wrong data reading. Oh wait, did you guys see that? Did we not just read there? Was it not just read at 5? Did you guys not see here really quickly? Did you guys not see 5%? It was red, right? Investing.com really needs to sort out their stuff, because I found like on different charts, different times, you'll sometimes get data, you won't get data. Like, that's insane. It was 5, right? Okay, so this is strange. I wonder how much of the markets got in a 5% mark. You know, from my perspective, I would love to try and catch this bar here. The problem is with these things is you can't tell how far it's going to fall. But from my perspective, right, a couple things here, right? And I just want to lay this out. We're going to break this down in a couple minutes as I go through the history of why, specifically on the PPI today, seeing that US 30 fell below market structure on the PPI. Even though for the first time in the longest of times, we've had a negative inflation month on the producer side. Seeing the US 30 fall below this market structure, why that was a red flag for me, and why this remains to be a red flag for me, right? So we're going to break this down. Now, it's going to sort of work itself out in the next couple of days, next couple of weeks. Economists, all the smartest minds in the world are going to break this down. In some cases, they're going to try and justify it, but let me go through the past data. We're going to go through that in a second to try and show you why that is that I don't like this move, I won't trade this move, and I won't deal with US 30 in a bit of a bear market structure, and I'll show you why. Yeah, guys, I can't deal with investing.com. Was it yesterday? When was it? I think it was yesterday. I believe it was on the CPI. I'm sitting here watching the CPI, refreshing the screen, and up to 2-3 minutes after the data was released, there was nothing available, right? I had to go to, I think it was Forex Factory to get the data, right? So gold on a massive sellout, US 30 on a massive sellout, US 100 on a massive sellout. And here's the big thing about this, is that these are moving into unprecedented levels, right? I would not be surprised if by the time we see Powell speaking, right, we see a recovery here, because this is what makes me suspect about these numbers. This is what makes me suspect about the moves. And bear this, mark my words, if this happens, and this is the reason why we're seeing things like this, right? When we see a spike down like this, specifically when all the past data leads to the fact that a slowing down of raising interest rates, a pause, or even just a temporary stop in raising interest rates should be positive, massively positive for the stock market. And yet we see the opposite, we see negativity. And in this particular case, right, we see some positive on the dollar, right? There's a couple things we need to talk about. Okay, so let's quickly maybe then use this as an opportunity to rewind. We still have about 10 minutes before we got to do a quick intermission to do battery change. But this is what we're going to end up going through, right? And this is going to give some perspective prior to Powell speaking. I wouldn't, again, everything I do is, nothing I do here is financial advice. I'll never tell you what to do, when to do it, how to do it. I can simply tell you from experience what I would do or what I'm going to do. And that's your decision as to, for yourself, what you want to do with your own money, with your own trading accounts. Again, not financial advice. However, I care nothing for this downside move, right? And all the way into Powell's speech. Now, someone might say, but this is liquid money. Yeah, but it's gambling, right? It's rolling a dice and saying, well, it's falling because of the data coming out. Surely, this is long term and this must last forever. You may be right, but you may not also be right. Now, the issue with this is that in order for me, and I'll tell you, this is where it gets a little bit more difficult from a trading perspective. When you've been trading for longer, you sometimes set these rules, right, in place that they need to be present and they need to make sense. And you need to be able to justify them in order to place a trade. And so, in the beginning days, I remember, and I'll share this with you guys, in the first year or two of trading, I didn't need a reason to place a trade. I just need to see it was moving and I'm in it. Why it was doing it, I cared not. For how long it was doing, for how long it was happening, I cared not either. And after some time, you start to build some rules. When you start to blow some accounts, make some mistakes, you start to go back to the drawing board, you start to write some rules, and then promise yourself you'd never deviate from that rule. One of those rules for me has been of the past is understanding why a move happened and agreeing with that move, right? In the sense that I got to have peace that I understand why it's moving and that makes sense. Now, granted, right, there's too much happening in the world in terms of being a geopolitically connected world. There's just too much happening at any one place in time to be fully aware of everything as and when it happens. Otherwise, we should be able to predict the future and we can't. So after some time, you create these rules that kind of, for a certain extent, you miss some movements, right? As this evening may be a case in point, right? We could have just straight sold it. But for me, I'll show you why in a second. And I'm hoping in the next couple minutes, you'll understand too why I would need to have logic here to be able to do this, right? So let's rewind and let's go back a little bit, right? So I've done this exercise. I really think you guys will enjoy, and I really want you to have a sip of coffee on this one and just sit back and, just pay a little bit of attention, because I'm going to be showing you guys something. And this is the type of logic that I use when in anything complicated, anything I need to dive through, anything I need to understand, anything I need to unpack or digest in the markets that may be complicated, may be simple. This is the kind of thinking that I use. And in the past, I've kind of just presented the data to people and just said, when this happens, deal with it. And I thought there's a lot more value in me explaining the process of how I came out to that position. And I may be wrong, I may be right, but it gives you an easier way of understanding and being a part of that. So what I have behind me, right, is the S&P 500, right? And what I've gone ahead and done, I've gone back through time and I've marked off past recessions, I've marked off past interest rates, I've marked off past collapses, past calamities, dot-com bubbles, interest rate, you name it, all the way into the 1990s, right? And based on that moment in time, I've got different charts to break down individual things there based on what happened there. So in any event, what I want to point out is I just want to walk you guys through the most recent pandemic COVID type events, right? So let's go there, right? So what I want to point out to you guys is that pre-COVID, right? And this is kind of the 2019, 2020 mark. Pre-COVID, S&P 500 index was climbing beautifully. But then ultimately, the rest of the world, COVID really hit, I would say, around the world, across the board. You can kind of see it on any market around the world. You'll see the dip, right? And it's not like you'll see one market drop, one market lift. Across the world, there's fear and panic. It's left a crater ring in the financial systems around the world, and you'll see the same crater ring everywhere. And for most of the world, that's going to be February 2020, right? So February 2020, what happens? We see, this massive drop. However, the US already knew, right, when this started to hit in China and there was a bit of a ripple effect, the US already started to see this happening December, January. And so by the end of January 2020, the first interest rate started dropping, right? So they started dropping interest rates to ease off the economy. right? So again, COVID lockdowns started happening in different places, specifically in China. There was already a fear of the spreading, the fear of travel happening. I don't know if you guys remember, I think was it Italy or Europe that had the first, I think it was Italy, right? Italy had the first kind of set of lockdowns. That was the first sign that, oh wow, actually, that was the first sign, oh shit, this is happening. And this is gonna, this is gonna spread. So I'm just repainting the picture because I want you to understand what happens in the world, what happens on charts. When you're looking too closely, it doesn't make sense, but when you're looking at this thing holistically, it will make sense. We see the drop in markets, right? So they dropped interest rates, and they started dropping interest rates to obviously curb and help the market. And I want you guys to pay attention to this, right? Dropping of interest rates continued all the way into May of 2020. This is the S&P 500, right? Interest rates dropped all the way into May of 2020, right? Now, pay attention to this, right? Once interest rates had hit their bottom, right? And what I want you to just take away from this chart quickly, when I switch to the dollar index, is when interest rates dropped, this created a healthy ecosystem in order for people to invest in the stock market, right? And for a couple reasons. I'm gonna go through those reasons really quickly. First reason being is that when interest rates are high, right, we have things like government bonds and other securities that are linked to the base interest rate, right? So here in Southern Africa, right, a lot of people, not a lot of people, but people may be confused about, what is, base interest from the Reserve Bank and what is prime and what do you get? So we have what's called a base interest rate, then we have what's called prime, and prime is generally 3% more than the base interest rate. In the US, the base interest rate, as we just saw, was 5.25%. There's a markup for what they refer to as prime, and then so on and so forth. Now, there's different instruments that are available depending on what the interest rates may end up being, right? So government bonds, securities that are government backed. So when interest rates are high, those are the safer options, right? Because you can get a government backed security or bond to invest in long term. And a lot of investing advice around the world says that, the older you get, the more you diversify into these lower yielding but safer securities like government bonds, things like that. So when interest rates drop, right, those government bonds, those yields no longer become attractive. And so there are other environments that become more attractive, i.e. the stock market, i.e. Wall Street. So lower interest rates just mean that pond that people were investing in slows up or sort of cools down and people start to get active in other areas, right? So I just want you to see this. Now I'm marking this off because I want you to see this. May of 2020. Now let's switch over and let's go have a look at the dollar index, right? Just side note, US 30 is still falling like an absolute stone. We're gonna ignore that for now because I promise you we're gonna make sense of this in a second, right? So let's go have a look at this. Right, let's have a look at, let's go here. Okay, so prior to COVID, dollar index, same thing. Dollar index rising. This is the dollar index on a 1 day time frame. Okay, and we see the start of COVID happen here, right? And what ends up happening, end of January, we see the first dropping of interest rates. Now, again, that dropping of interest rates starts a bunch of transactions. Initially, the dollar will always benefit from the changing of all currency hands, things like that. There was initial benefit to the dollar, then COVID officially hit the rest of the world. And then have a look at what happens almost directly after COVID hits the rest of the world, right? We see the dollar absolutely spike in value. And the reason of that is that because the dollar is the world reserve currency. So when countries are panicking, when we see European countries getting slammed with the pandemic, so on and so forth, the rest of the world start to see the dollar just like they see gold as a safe haven, right? There's a reserve currency, it must stay strong, so on and so forth. However, I want you to take note of where were interest rates at their bottom, right? Now have a look at this. Just look at the price action, ignore the other things I'm saying. Have a look at this, right? Again, from 2018, mid 2018 to the pandemic, the dollar was on the rise, right? With stock markets, great. In normal times, these tend to move together. And we're merely looking at recessionary times or times of panic or fear or pandemic, right? Have a look at the start or the middle of 2020. Interest rates hit their bottom, right? Let's go back to the S&P 500, right? Yeah, interest rates hit their bottom. What happens? The US stock market starts to take off, starts to thrive off of this low interest environment. And what happens to the dollar, right? The dollar starts to tank. Why? Its investability starts to taper off. Okay, check what it is I'm busy saying. Okay, the dollar starts to make a bottom end, tries to make a little bit of recovery, but ultimately remains below pre-pandemic eras, right? Now, have a look at what happens the start of 2022. So remember, from pandemic to start 2022, the dollar was suffering, right? Low interest rates, zero, almost zero, right? There was a point in time in the US where it was cheaper to go and take money on your credit card or through the bank than it was to use your own money in cash, right? Just think about that for a second. I had business partners, friends in the US, their businesses were being offered hundreds of thousands of dollars in almost interest-free, potentially not even repayable loans, the government just offering as assistance to boost and stimulate the economy. This is part of the issue, right? This is just that part of printing money to inject into the economy. Raising interest rates or dropping interest rates, one measure that they have. The other measure they have is let's just print a bunch of money and shove it into the economy, right? And stimulate activity. This is where the inflationary issue comes from. However, let's just pay attention to this, right? Let's have a look here. January, February 2022, right? What happens? What happens here that causes the dollar to spike? Let's give it a look. Let's go back to the S&P 500. Let's move on in time, right? So 2022, what happens? Stock market thrives. Everybody around the world saying it's amazing. Stock market, the US economy, most robust, you name it. Let's have a look here. What happens in January or February 2022? They start rising interest rates. Why? Because the economy is running red hot. The US economy is thumping. Unemployment's at an all-time low. Why? What just happened, right? Because they just shoved a bunch of artificial money down the throat of the US economy while the rest of the world is suffering, right? So that what happens? Inflation. $1 buys less and less and less over time. So at the end of January, sort of February 2022, Powell comes on TV, or the Federal Reserve says, hey guys, listen, inflation is running away. We need to do something to stop the US economy heading into obviously rampant inflation, but also a hard recession, right? Because again, when something goes up too fast, it has to come down. And this is the other thing people need to understand, is that a recession is simply, people take it as this bad term. A recession is just another word for correction, right? When you have a really, really good time, right, you're going to have this period of not such a good time to correct the good time. Think about it when you go out and you have too much to drink. You might have an amazing time, but you're going to feel super crap in a little bit, right? You're going to pay for that a little bit later. Very, very similar thing, right? So having a look at it, end of Jan 2022, interest rates are rising. The start of the rising of the interest rates. Have a look what happens on the dollar. Rising interest rates. Oh, wow. Look what happens to the dollar. Rising interest rates. Oh, no. Look at the dollar. Dollar starts absolutely performing and dominating. There we go. You can see it right there on your screen, folks. There's January 2022, right? The first week in February, after interest rates have been announced, what happens? The dollar says hell yes and starts running through the ceiling. Why? Right? Again, as I said, you raise interest rates, it becomes extremely attractive to invest in government-backed securities, right? These bonds and these treasury yields, these become very, very attractive, right? And the US dollar starts to attract all this foreign investment because, wow, this is a attractive, fertile environment to place my money. So people will diversify, take money out the stock markets that's high yielding for something safer and more secure. Think about this and remember this, right? So interest rate rises, dollar starts absolutely dominating, right? Until when? When does the dollar stop dominating? Let's have a look here. Market structure and price action being king as always. Let's have a look here. Markets stop dominating, let's say November, middle November, start of December 2022. Now, for those of you who've been following for a while and be following what I do and how we do it, if you guys remember clearly, December was where Powell came in and said, hey, listen, the effects of, rising interest rates, the effects of what we're trying to do, we're starting to see them. They're not quite there yet, but we are confident we're going to have a soft landing. We're going to bring the economy down to a place of normality, right? That was the first sign that Powell said, hey, what we're doing is working not perfectly, but we're starting to see this red hot economy start to slow down, starting to see unemployment rise ever so slightly, right? If you guys remember, you're following in the broadcast, that's what happened in December 2022, right? Have a look at what happened, right? The second they said, hey, listen, December 2022, listen, the economy, let's just double check here. Just want to see here, December 2022. Let's go double check quickly. Right, so I just want to point out quickly, right, before we get carried away here, they started raising interest rates the start of 2022. I just want to go back to S&P 500 and show you that. What was the result of that? Yeah, they started raising interest rates 2022, right? This was the worst year in the stock markets. I can't remember in how long. I think they said in the past, I can't remember exactly. I think it was something stupid like the past 40 something years, right? That right there, the worst year in the stock markets in the past 40 something years. Why? Because they're raising interest rates. People were getting out of the stock market and going back into government bonds, yields, treasuries, right? Now, let's give this a quick look here, right? Let's have a look at what points did the US stock market potentially start turning around. Let's give it a quick look, right? If we measure here, we can see that at the end of November, the start of December, the US economy started its first potential breakout, or showing the first signs that it wants to potentially break out, right? And why was that? As I was saying a little bit earlier, if we look at that exact moment in time, it's right there, right? November, December, right? 2022, right? This is where Powell started saying, hey guys, we're seeing the results, the fruits of our labor. This hasn't all been for nothing. We're starting to see things come back in order, and we're starting to see the US economy start to slow down. There's hope yet. We might get this right. We're figuring it out. So they're going through the data. He started to treat this thing with a bit of love, right? And this is when we talk about hawkish or dovish. This is what we're referring to. Dovish is when Powell comes across a little bit more loving, a little bit more, our efforts are starting to materialize, we're starting to see something come out of this, and there's hope for the future. We're starting to see, but still remaining a little bit stern and saying we still have a long way to go, etc., etc. That's dovish. That's loving. It's tentative. It's great for the stock market. Stock markets love that. It's bad for the dollar, because remember, the dollar thrived on a hard Powell, a hawkish Powell, a Powell saying, we are the strongest market in the world, the United States, greatest nation on earth. We will do whatever it takes within our power to bring inflation under control, right? Whether that's people losing their jobs, whether it's over squishing the economy, whatever it may take. That was the hawkish approach that scared the stock markets. Because again, hawkish means what? Hawkish means raising interest rates further to overfight inflation. And that is what is the big talking point right now in the world of finance amongst those who know. It's that, has the US Federal Reserve overdone it? Have they pushed the US economy into a bad space? No. Look at the price action. The price action shows it very, very clearly to us. And this is why when we take this into account, right? So summary, what's the quick summary, right? Lowering of interest rates in times of pandemic, injecting money into economy, what does that do, right? It's not good for the stock market. Initially dollar, stock market, anything like that, any term of crisis is bad for the economy as a whole. But essentially what ends up happening, low interest rates, tiny low interest rates basically stimulates the US economy from a stock market perspective. Remember, the US 30, the S&P 500, the NASDAQ, these are all publicly traded companies, right? So when consumers have more money, they buy more Apple products, they buy more Microsoft products, they buy more Tesla vehicles, they're investing in spending more money in all these companies, right? So when the US economy is stimulated, the stock markets traditionally grow, but over and above the outside investing. So low interest rates, great environment for stock market. When they start rising interest rates to fix the damage of potential inflation, stock markets don't like that. But the stock markets do like being told, hey, we are reaching a point, we are coming to a point of conclusion, right? That is what we saw at the end of 2022. Now, if we go and have a look at that, where is the US 30 right now? based on what it is that I've said tonight. Let me show you, and that's why I'll show you in a couple seconds why I don't agree with the data we're seeing that supports a disinflationary cycle with the way that the market's reacting, specifically on the dollar, specifically on the US30, specifically on NASDAQ as well as gold. And I'll show you why in a second. So let's quickly back it up, right? Let's go have a look at US30. Okay, let's go into a daily time frame, and I might need to just change charts for a second. I might need to just grab a cleaner chart here. So let's start off with, there we go. Okay, so this might look familiar to you, right? Again, this is US30 on a daily time frame, and you'll notice it looks very, very similar to what? S&P 500, because they are very, very similar, right? On the bigger time frames, they're very, very similar. So here's the S&P 500, here's the start of 2022, the collapse over 2022, and then this is the potential start of the next bull market, right? Let's look at that translates. Well, there's, pre-2022, start of 2022, what happens? Rising interest rates, US30 goes sideways, technically into bear territory, the worst, year in the markets in however many years. And let's have a look here, right? There's November. Oh wait, what happened in November? Right, Powell signaled we might be in a state of recovery. Okay, this is interesting. So that happens, right? So we go into that state of potential recovery. January happens, February happens, we get that crazy data that shows inflation may still be there. And look at where we are now, okay? So if we just draw a parallel to where we were there in time, and I'm just going to do this, I'm going to do this roughly. I just want to show you this quickly, how this translates, right? You can see that when we talk about the end of May, right? And this is why I was talking about that particular area of retest being so important. If you've been in the live broadcasts in May, that is why that was such an important zone for US30 to maintain and stay above. If you look at that zone, we came back down. But you can clearly see, guys, we're in bull territory. The US30 is clearly saying to us, the stock market is clearly saying to us, regardless of all the politicians and their bullshit, the stock market's saying we're in new bull territory, right? It's broken out of the 1 year bear trend. It's come back for the retest, which I believe that's a retest. And now we're starting to move out into the space. And why is that? The S&P 500, the US30, the NASDAQ, these are all essentially reacting off of the same thing, ladies and gentlemen. They're all reacting off the fact that inflation is coming under control and we're moving into this new state of markets. Now, listen to this. If the state of the US30, the state of US 100, S&P 500, etc., are all based on the fact that inflation is coming under control, and then we start to see, and that's why I messaged and I sent that message in Premium Plus, right? The US stock market's been praying, Wall Street's been praying for the data that we just saw on the CPI and the PPI for the last year. Why do I say the last year? From 2022, being in bear territory, right? They've been praying for this data since then, okay? They've now got that data. CPI came in under expectation, beat inflation, right? PPI under expectation, beat inflation. Yet we're seeing these markets sell off. And yet we're seeing these markets in the state that they are. Understanding that these markets are in bull territory because this lower inflationary reading gives Powell the necessary info he needs to say, guys, the US economy is under control. We did the right things and we're going to start to ease up on these interest rates. And potentially we may hike in the future. We may need to, and he'll always say that to build the confidence of the markets. But, all he needs to say is that, guys, our efforts are working. We're starting to see that evidence here. The fact that the market's selling off with all that info in hand, that's why I'm saying I can't create a sell order on US30, US 100, because based on all the past data, it does not make sense from that perspective, right? Understanding everything I've just told you now. Now, you may want to watch us tomorrow when it's not, the time you're supposed to be going to bed to fully absorb and understand this. But this is some of the reasons, and I'm hoping this translates and that you guys this is sinking in. I'm not seeing too many people saying they're understanding what I'm saying, and I'm just hoping you do. I know sometimes I speak about these things as if it's simple, and I agree it's not simple just to grasp and understand, and it's not a simple thing just to grasp, but I'm really hoping that through what we're doing here, this will start to make sense and will start to make you a better trader, just a better citizen of the world, understanding more about what's going on, having better control over your own future, over your own destiny. So we're going to check that in a second. However, guys, before we do that, what we're going to go ahead and do is we're going to just do a quick, I'd say not even 20 seconds. We're going to do, let's do a 20-second intermission. We're just going to do a quick battery change. And then we are going to switch over to Powell, listen to his reasoning, and then we're going to watch the markets, because I am sure that if his reasoning comes through dovish the way I expect it to come through, we're going to see a recovery on all the markets we've just seen. All that bear movement, we should see recovery based on past data. So let's jump in, quick intermission. Give us 20 seconds. We'll be right back with you. Okay, beautiful things. So it is working. I keep selecting the wrong screen right there. I still need to show you guys a new studio layout. I'm really loving it, having a great time. However, we're going to switch over to the press conference and listen in. So let's quickly switch over.
Without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. And I will have more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer-run normal growth rate. The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer-run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the Consumer Price Index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile and food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a half percentage point higher than in our March projections. I hasten to add, as always, that these projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. I'm curious what gives you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated. Interest rate sensitive sectors like housing, while they've felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
So I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were three issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not decide or really discuss anything about going to an every other meeting kind of an approach or really any other approach. We really were focused on what to do at this meeting.
So there was no kind of initial debate about the possibility of July, any sense of the initial support at this stage for that move?
So again, we didn't make a decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July 2 things. One, decision hasn't been made. 2, I do expect that it will be a live meeting.
Thanks, Howard Schneider with Reuters. I was just wondering if you could help us understand the narrative here, because it feels like there's been a level shift in the dots, stronger GDP, less of a hit to unemployment, slower progress on inflation, and I'm wondering, in this sort of, where's the disinflation coming from?
Sure.
The labor market's going to be stronger, it looks like. It's not coming from there. Demand's not coming down all that fast, according to GDP. You've doubled your estimate of GDP. So what's the narrative here? It seems like it's getting more immaculate rather than more messy.
So you're right that the data came in, I would say, consistent with, but on the high side of expectations. So, and if you go back to the former SEP, the last SEP in March, you will see that growth moved up. These are not huge moves, but growth estimates moved up a bit. Unemployment estimates moved down a bit. Inflation estimates moved up a bit. And, all three of those kind of point in the same direction, which is, that perhaps more restraint will be necessary than we had thought at the last meeting. So although the level, frankly, is pretty, the level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So we've kind of gone back to that. So your question is, where's the disinflation going to come from? And I don't think the story has really changed. The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. It's going to take some time. And I think you go back to the three-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see continued healing in supply side conditions. They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation to continue to come down over time. In terms of housing services inflation, that's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any forecast that people are making right now about inflation coming down this year will contain a big dose of this year and next year, will contain a good amount of disinflation from that source. And that's, again, probably going to come slower than we would expect. That leaves, the big sector, which is a little more than half, pardon me, of core PCE inflation. That's non-housing services. And, we see only the earliest signs of disinflation there. It's a sector, it's a very broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive. And I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions, which we have seen. We have actually seen, I go through a number of indicators suggesting there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time.
Nick Timmeros of the Wall Street Journal. Chair Powell, what's the value in pausing and signaling future hikes versus just hiking now? I mean, not to be flippant, but I don't lose weight just by buying a gym membership. I have to actually go to the gym. 16 of your colleagues put down a higher year-end 23 rate today. A majority of you think you're going to have to go up by 50 basis points this year. So why not just rip off the Band-Aid and raise rates today?
So first, I would say that the question of speed is a separate question from the question from that of level. Okay, so and I think if you look at the SEP, that is our estimate, our individual. It's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting. It's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting. And so the committee thought overall that it was appropriate to moderate the pace, if only slightly. And there are benefits to that. So that gives us more information to make decisions. We may try to make better decisions. I think it allows the economy a little more time to adapt as we make our decisions going forward, and we'll get to see. We don't know the full extent of the consequences of the banking turmoil that we've seen. It would be early to see those, but we don't know what the extent is. We'll have some more time to see that unfold. I mean, it's just the idea that we're trying to get this right, and this is if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision makes sense.
I know you said July is live with only one June employment, with only the June employment and the CPI report for June due to be released before the July meeting. You get the ECI after, you get the senior loan officer survey after, you get some bank earnings at the end of next month. What incremental information will the committee be using to inform their judgment on whether this is in fact a skip or a longer pause?
Well, I think you're adding that to the data that we've seen since the last meeting too. Since we chose to maintain rates at this meeting, it'll really be a 3-month period of data that we can look at. And I think that's a full quarter, and I think you can draw more conclusions from that than you can from any 6-week period. We'll look at those things. We'll also look at the evolving risk picture. We'll look at what's happening in the financial sector. We'll look at all the data, the evolving outlook, and we'll make a decision.
Thanks for taking our questions. Gina Smilek, New York Times. You obviously, in your forecast, marked up the sort of path for growth, marked down the path for unemployment, and marked up the path for inflation pretty notably. I wonder, since March, what has changed to make you think that the economy is a lot more resilient and inflation is going to be a lot more stubborn? And given that, why do you feel confident that this is as high as you're going to have to revise the federal funds rate, or do you think it's possible we could have even a higher than 5.6% terminal by the end of this cycle?
You know, I mean, on the first part, I just think we're following the data and also the outlook. The economy the labor market, I think, has surprised many, if not all, analysts over the last couple of years with its extraordinary resilience, really. It's just remarkable, and that's really, if you think about it, that's what's driving. It's job creation, it's wages moving up, it's supporting spending, which in turn is supporting hiring, and it's really the engine, it seems, that is driving the economy. So it's really the data. In terms of, you know, we always write down at these meetings what we think the appropriate terminal rate will be at the end of this year. That's how we do it. It's based on our own individual assessments of what the most likely path of the economy is. It can actually, in reality, wind up being lower or higher. And you know, there's really no way to know. But it's what people think as of today. And as the data come in, it can move around during the intermeeting period. It could wind up back in the same place. But it really will be data driven. I can't tell you that I ever have a lot of confidence that we can see where the federal funds rate will be that far in advance.
Mr. Chairman, thanks for taking my question. You had said back at the end of May that you thought risks were getting closer to being into balance. Is that still the case, or has your mind changed about the balance of risks out there? And also, could you give us an idea of what would be a sufficiently restrictive funds rate? Obviously, the current rate, according to the committee, is not sufficiently restrictive. Is it 5.6? Is it 6? Where is it sufficiently restrictive? Thank you.
You know, I would say again that I think that over time, the balance of risks, as we've moved from from interest rates at effectively 0 now to 5 percentage points with an SEP calling for additional hikes, I think we've moved much closer to our destination, which is that sufficiently restrictive rate. And I think that means, almost by definition, that the risks of sort of overdoing it and underdoing it are getting closer to being in balance. I still think, and my colleagues agree, that the risks to inflation are to the upside still. So we don't think we're there with inflation yet, because we're just looking at the data. And if you look at the full range of inflation data, particularly the core data, you just aren't seeing a lot of progress over the last year. Headline, of course, inflation has come down materially, but as you know, we look at core as a better indicator of where inflation overall is going. So I think, you know, what we'd like to see is credible evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see. And I think it's also, we understand that there are lags, but remember that it's more than a year since financial conditions began tightening. I think the reason we're comfortable pausing is that we are still, much of the tightening took place over last summer and later into the year, and I think it's reasonable to think that some of that may come into effect. So we're, you know, I think stretching out into a more moderate pace is appropriate to allow you to make that judgment of sufficiency, you know, with more data over time.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I wanted to ask further on the lag effects. When you're considering when you would hike again throughout the course of the year, are there things that you would expect to kick in as those lag effects come into effect that would inform your decisions? Have you learned things over the past year that give you some sense of timeline for when to expect those lags to come into effect?
Yeah. So it's a challenging thing in economics. It's sort of standard thinking that monetary policy affects economic activity with long and variable lags. Of course, these days, financial conditions begin to tighten well in advance of actual rate hikes. So if you look back when we were lifting off, we started talking about lifting off. By the time we had lifted off, the 2-year, which is a pretty good estimate of where policy is going, had gone from 20 basis points to 200 basis points. So in that sense, tightening happens much sooner than it used to in a world where news was in newspapers and not on the wire. So that's different, but it's still the case that what you see is interest-sensitive spending is affected very, very quickly. So housing and durable goods and things like that. But broader demand and spending and asset values and things like that, they just take longer. And you can pretty much find research to support whatever answer you would like on that. So there's not any certainty or agreement in the profession on how long it takes. So, and that makes it challenging, of course. So we're looking at the calendar, we're looking at what's happening in the economy, we're having to make these judgments. And again, it's one of the main reasons why it makes sense to go at a slightly more moderate pace now as we seek that ultimate. I can't point to that ultimate endpoint. I can't point to a specific data point. I think we'll see it when we see inflation, really flattening out reliably and then starting to soften. I think we'll know that it's working. And ideally, by taking a little more time, we won't go well past the level where we need to go.
I was curious if you could give us an update on what you're seeing on credit tightening since the bank incidents from March and how you're teasing that out apart from these lag effects.
So it's too early still to try to assess the full extent of what that might mean. And that's something we're going to be watching, of course. And if we were to see what we would view as significant tightening beyond what would normally be expected because of this channel, then we would factor that into account in making rate decisions. So that's how we think about it.
Let's go to Chris.
Thanks. Chris Rugaber at Associated Press. You mentioned that many of the trends are in place that you want to see. Core services ex housing has come in pretty low in the past couple of months. And as you noted, a significant portion of core inflation is now housing prices. And then we've had some quirks in used car prices. So given that these trends are in place, I guess I'm sort of asking the flip side of Nick's question, why signal additional rate hikes? Aren't things headed in the direction you need? Why not simply give it even more time? Or it's surprising to see so much hawkishness in the dots, given what we're seeing recently.
Yeah, so we're 2.5 years into this, or 2.25 years into this, and forecasters, including Fed forecasters, have consistently thought that inflation was about to turn down, and typically forecasted that it would, and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running at a level over 4.5%, far above our target, and not really moving down. We want to see it moving down decisively. That's all. Of course, we are going to get inflation down to 2% over time. We want to do that with the minimum damage we can to the economy, of course, but we have to get inflation down to 2%, and we will. And we just don't see that yet. So, hence you see today's policy decision, both to write down further rate hikes by the end of this year, but also to moderate somewhat the pace with which we're moving.
Quick follow-up. I mean, the last press conference you mentioned you didn't see wages driving inflation, and there was some research from the San Francisco Fed suggesting wages aren't necessarily a key driver, but you've talked about the labor market today and the need for softening. Can you give us a little more specifically of how you see the tight labor market driving inflation at this point? Thank you.
Right. So I'm not going to comment on any particular paper, but I would say that I think the overall picture is that at the beginning, in early 2021, inflation was really coming from very strong demand largely for goods. People were still at home. They had money in the bank, and they wanted to spend, and they spent a lot on goods. And of course, at the same time, and because of that high demand to some extent, supply chains got all snarled up. So prices went way up, inflation went way up. That was the origin, and it wasn't really particularly about the labor market or wages. But as you move through 21 into 22 and now in 23, I think many analysts believe that it will be important, an important part of getting inflation down, especially in the non-housing services sector, to getting wage inflation back to a level that is sustainable, that is consistent with 2% inflation. We actually have seen wages broadly move down, but just at a quite gradual pace. So, and that's a little bit of the finding of the Bernanke paper with Blanchard of a few weeks ago, which is very consistent with what I would think.
Michael McKee from Bloomberg Radio and Television. You've said in the past that you don't like to surprise markets. It's kind of been the Fed's view. Markets should have an idea of what you're going to do before you go in. You also said a number of times that it would take a while to bring inflation down. You reiterated that again today, and that we would get to a point where inflation could be sticky. So I'm wondering, as we go into the next meetings, how Wall Street or others should look at your reaction function. What will you be reacting to, time or data? In other words, if nothing much changes, if we're looking at the same sort of labor market, the same sort of inflation levels in July or in September or November, will you move because you've said you feel you need to? Is it time that's going to require additional movement, or would it be a reversal in inflation?
So I don't want to deal with hypotheticals about different ways data might move out. So we of course we don't go out of our way to surprise markets or the public. At the same time, our main focus has to be on getting the policy right, and that's what we're doing here, and that's what we'll do for the upcoming meetings. I will say the July meeting will be live, and we'll just have to see. I think you'll see the data, you'll hear Fed people talking about it, and markets will have to make a judgment.
Well, do you think inflation is likely to continue coming down based on the lags and based on your threat of additional movement, or are we going to be in a period where we're not going to know what's happening?
I think if you look at if you just look at, I'll just point you to the forecast. So inflation is running, core PCE inflation is running at about 4.5%, a little higher than 4.5%, and the median FOMC participant thinks it'll go down to 3.9 on a 12-month basis. This is by the end of this year. So that's expecting pretty substantial progress. That's a pretty significant decline for half a year. So that's the forecast. We do try to be transparent in our reaction function. We're committed to getting inflation down, and that's the number one thing. So that's how I think about it.
Let's go to Victoria. Victoria Guido with Politico. Could you talk about the balance sheet and how you're thinking about it? What are you looking for to judge whether we're approaching reserve scarcity, and is Treasury issuance going to affect that? Also, are you considering lowering the RRP rate in order to take some pressure off banks?
So let me say, first of all, on the Treasury part of it, if I can talk about that, and then go back to the balance sheet. So on that, of course, we've been very focused on that for a couple of months, as everyone has. Treasury has laid out its borrowing plans publicly. I think I saw the Secretary's comments yesterday to the effect that Treasury has consulted widely with market participants about how to avoid market disruption, and that they're going to watch carefully for that. So that's from the Treasury, which actually sets the borrowings. At the Fed, we'll be monitoring market conditions carefully as the Treasury refills the TGA. The adjustment process is very likely to involve both a reduction in the RRP facility and also in reserves. It's really hard to say at the beginning of this which will be greater. We are starting at a very high level of reserves and still elevated over RRP to take up, for that matter. So we don't think reserves are likely to become scarce in the near term or even over the course of the year. So that's the Treasury part of the answer. We will, of course, continue to monitor conditions in money markets, and we're prepared to make adjustments to make sure that monetary policy transmission works. Was there another part of your question?
Yeah. What are you considering lowering the RRP rate to help take some pressure off banks?
So we have a number of, I would say, the RRP doesn't look like it's pulling money out of the banking system. It's actually been shrinking here lately. So I don't think that's not something we've thought about a lot over time. It doesn't really look like that's something we would do. I think it's a tool that we have. If we want to use it, we can. There are other tools we can use to address money market issues, but I wouldn't say that that's something that's likely that we would do in the near term.
Janelle Marte with Bloomberg. Have you seen sufficient cooling in the housing market to bring inflation down? For example, how does the recent rebound affect your forecast, and how does it factor into monetary policy?
So certainly housing, very interest sensitive, and it's the first place really, or one of the first places that's either helped by low rates or that is held back by higher rates. And we certainly saw that over the course of the last year. We now see housing putting in a bottom and maybe even moving up a little bit. We're watching that situation carefully. I do think we will see rents and house prices filtering into housing services inflation, and I don't see them coming up quickly. I do see them kind of wandering around at a relatively low level now, and that's appropriate.
Do you think you'll have to target that with further rate increases?
Well, I think we look at everything. We don't just look at housing. So I think, the way it works is individual participants sit in their offices all over the country and they write down their forecast, and including their most likely forecast, including their rate forecast, and then they send it in on Friday afternoon, and we accumulate it, and then we publish it for you. So that's how they do that. Well, I don't know that housing is itself going to be driving the rates picture, but it's part of it.
Thank you for taking the question, Mr. Chairman. Edward Lawrence with Fox Business. So I want to go back to comments you made about, in the past, about unsustainable fiscal path. The CBO projects the federal deficit to be $2.8 trillion in 10 years. The CBO also says that federal debt will be $52 trillion by 2033. At what point do you talk more firmly with lawmakers about fiscal responsibility? Because I'm assuming monetary policy cannot handle alone the inflation or keep that inflation in check with the higher level of spending.
I don't do that. That's really not my job. We hope and expect that other policymakers will respect our independence on monetary policy, and we don't see ourselves as the judges of appropriate fiscal policy. I will say, and many of my predecessors have said, that we are on an unsustainable fiscal path, and that needs to be addressed over time. But I think trying to get into that with lawmakers would be kind of inappropriate, given our independence and our need to stick to our knitting.
Is there any conversation then about the Federal Reserve financing some of that debt that we're seeing coming down the pike?
No, under no circumstances.
Thanks for taking our questions, Chair Powell. So looking at the SEP, it looks like GDP for this year was raised significantly, your forecast for GDP this year. The unemployment rate, meanwhile, was pulled downward. And so should we take that as a sign that the committee is more confident about the prospects of a soft landing, at least as it relates to what you were expecting in March?
I would just say it this way. I continue to think, and this really hasn't changed, that there is a path to getting inflation back down to 2% without having to see the kind of sharp downturn and large losses of employment that we've seen in so many past instances. It's possible. In a way, a strong labor market that gradually cools could aid that along. It could aid that along. But I guess I want to come back to the main thing, which is, though, simply this. We see, the committee, as you can see from the SEP, the committee is completely unified in the need to get inflation down to 2%, and will do whatever it takes to get it down to 2% over time. That is our plan. And, we understand that allowing inflation to get entrenched in the U.S. economy is the thing that we cannot allow to happen for the benefit of today's workers and families and businesses, but also for the future. Getting price stability back and restored will benefit generations of people as long as it's sustained, and it really is the bedrock of the economy, and you should understand that that is our top priority.
Just a quick follow-up on that. I'm just a little confused because you said the committee will do whatever it takes to get inflation down over time, but when I look at the SEP, inflation is still projected to be elevated next year, but the Fed funds rate is lower than where it is now. Can you help me understand that?
Sure. So, if you look 2 and 3 years out with the forecast, first of all, I wouldn't put too much weight on forecasts even 1 year out because they're so highly uncertain. But what they're showing is that as inflation comes down in the in the forecast, if you don't lower interest rates, then real rates are actually going up, right? So just to maintain a real rate, the nominal rate at that point, 2 years out, let's say, should come down just to maintain real rates. And actually, you know, since we're probably going to, we're having real rates that are going to have to be meaningfully positive and significantly so for us to get inflation down, that probably means that certainly means that it will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate if you think about it. Inflation has not really moved down. It has not so far reacted much to our existing rate hikes, and so we're going to have to keep at it.
Julie. Oh, sorry. Thank you. Hi, Chapel. Julie Chabanas, AFP News Agency. The May job report showed a rebound in May in black workers' unemployment. Is it consistent with the Fed's maximum employment mandate? Are you worried about that, about this rebound?
So we are, of course, worried about, there are long-standing differences in racial and ethnic groups across our labor market. That's a factor that we can't really address with our tools, but we do consider that when we're thinking about what constitutes maximum employment. It is for us a broad and inclusive goal. And so we do watch that. But remember, all unemployment, including black unemployment, has been bouncing around right near historic lows, historic modern lows here. So we're still talking about, I mean, what is as strong a labor market as we've seen in, you know, a half century here in the United States. So overall unemployment of 3.7% is 0.3 higher than it was measured to be at the last a month ago, but still it's extraordinarily low. And so it's a very, very tight labor market.
Thank you. I want to follow up first a little bit just on the rent question on housing. We heard Governor Waller talk about how, I'll back up, we haven't quite seen the slowdown in rents show up in CPI yet, and we did hear Governor Waller talk about how an uptick in housing might mean that there's not going to be as much relief coming or a shorter bit of relief than we thought. Can you talk about how you're thinking about that and how that played into today's outcome?
I wouldn't say, so that's, you know, as a factual matter, that's correct. We do need to see, you know, rents bottom out here or at least stay quite low in terms of their increases, because we want the, you know, we want inflation to come down, and rental is a very large part of the CPI, about a third, and it's about half of that for the PCE. So it's important, and so it's something that we're watching very carefully. It's part of the overall picture. I wouldn't say it's the decisive part, but take a step back. What you see is look at core inflation over the past 6 months, year. You're just not seeing a lot of progress, not the kind of progress we want to see, and it's hard to avoid that. And you know, the committee, people in the committee, the median went up significantly, so that the median participant now thinks that core PCE inflation on a 12-month basis will be 3.9% this year. So once again, every year for the past 3 years, it's gone up over the course of the year, and it's doing that again. So we see that, and we see that inflation forecasts are coming in low again, and we see that tells us that we need to do more. And so that's why you see the SEP with where it is.
Could you also talk briefly about your outlook for wages, and given the recent slowdown in core services excluding housing, how far you think wages might need to fall in order to get inflation back in line?
So wages will continue to increase. So we you know, what we're talking about is having wage increases still at a very strong level, but at a level that's consistent with 2% inflation over time. And so I think we've seen some progress. All of the major measures of wages have moved down from extremely elevated, not extremely, but highly elevated levels a year or so ago, and they're moving back down, but quite gradually. And you know, we would want to see that process continue gradually. Of course, it's great to see wage increases, particularly for people at the lower end of the income spectrum. but we want that as part of the process of getting inflation back down to 2%, which benefits everyone. I mean, inflation hurts those same people more than anyone else. People on a fixed income are hurt the worst and the fastest by high inflation.
Thank you so much, Chair Powell. Greg Robb from MarketWatch. I just wondered if the committee has talked at all about the labor market, and there's strikes now in Hollywood, and now the United Auto Workers are talking about a possible strike. I mean, aren't workers, we have some, workers have power now and are going to be seeking higher wages. Does that come up in your discussions? Thanks.
So the topic of wages in the labor market and dynamics in the labor market is about as central a topic to our discussions as anything. I mean, it's very, labor economics, you know, and the labor market are utterly central. You know, it's half of our mandate. So we spend a lot of time talking about that. I think, you know, there are structural issues that are really not for the Fed. And so we don't spend a lot of time, although we take notice of what's going on. But we're not, you know, we're not involved in discussions or debates over strikes and things like that. But we, you know, we look and we see what's going on, and you know, we're making judgments about what it will take to get inflation down to 2% in the aggregate. And as I said, don't think that was about, most folks would say now, it wasn't really about that, about wages at the beginning. And it's becoming more about that as we get into really service sector inflation, which is the part of the economy where we have seen the least progress.
Let's go to Mark for the last question.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. Wondering what your thoughts are now about systemic risk, now that we're about 3 months past the failure of Silicon Valley Bank, and also specifically, what are the risks associated with commercial real estate as well as non-bank financials, and could you further elevate those risks with higher still rates, possibly for longer?
So we're trying to think where to start. I'll start with commercial real estate. Of course, we're watching that situation very carefully. There's a substantial amount of commercial real estate in the banking system. A large part of it is in smaller banks. It's well distributed. To the extent it's well distributed, then the system could take losses. We do expect that there'll be losses, but there'll be banks that have concentrations, and those banks will experience larger losses. So we're well aware of that. We're monitoring it carefully. You know, it feels like something that will be around for some time, as opposed to you know, something that will suddenly hit and you know, work its way into systemic risk. In terms of non-bank financial sector, there's been a ton of work, and you know, clearly in the pandemic, it really was it was the non-bank financial sector where issues really arose, and you know, there's a lot of work going on with the administration, in particular, leading that to try to address issues in the Treasury market and in all kinds of areas in the non-bank financial market. But you know, our jurisdiction at the Fed is over banks, actually bank holding companies and some banks. So that's really our main focus. You know, in terms of the events of March, as I mentioned earlier, we will be carefully monitoring that situation. You know, our job generally involves worrying about a lot of things that may go wrong, and that would include the banks. It might be hard for me to identify something that we don't worry about rather than that we do worry about. So we're watching those things very carefully. And as we see things unfold, as we see what's happening with credit conditions and also all the individual banks that are out there, you know, we'll be able to take, to the extent it's appropriate, we can take, if there are macroeconomic implications, we can take that into account in our rate setting. And so I guess that's what I would say.
Can I just follow up on the last part? That's, do you risk further exacerbating those issues if you get up to another 50 basis points?
So that's, and I guess I meant to address that by saying, as we watch, we'll see what's happening, and if we're seeing the kind of tightening of conditions that you could be referring to, then we can factor that, because really we use our rate tool it really has macroeconomic purposes, so we'll take that into account. Of course, we have responsibility for financial stability as well, And that also is a factor that we're always going to be considering. Thank you very much.
So, okay, that wraps that up, guys. So I don't know about how much everybody listened, if everyone was listening for the full thing or where people drop off towards the end there, but there was a lot said, right? And really, really important stuff. Now, this is part of being a trader, right? Is sometimes we've got to put in the time, put in the effort. And again, I mentioned this morning or yesterday is that a ton of the time we spend in the markets, our money is mostly being made not while hitting the buy and sell button. It's the time, it's the hours, it's the commitment to everything else, right? This is part of that process, right? To understand what's going to be happening at the next Fed meeting, to understand when the next set of data comes out, to put yourself in the position of the Federal Reserve and some of these big decision makers, these questions, these answers, and that's why I put in the comments, it must be extremely hard to be Powell, right? Because all questions he is given, even though the markets and the reporters have a deep respect for him, right? Because he's separated, the Fed's not part of the politicians, they're not part of, that's why he said, it's not my job to force them to make it, policy changes. Our job is, price stability and employment, So, all the questions he's getting is to try and reveal his hand, to try and tell, the rest of the world where things are going. It's a very difficult job to balance, the power that the Federal Reserve yields, which they do. It's largely argued that Powell, Jerome Powell, Papa Powell, who obviously referred to him as, is probably one of the most powerful people in the financial world, more than the president, right? Because every single thing he says is hung on to, every word gets overanalyzed, reanalyzed, his facial tones, his everything. I can tell you now, after this, there's going to be people that are putting his face into algorithms to understand his mood, his breathing exercise, everything, how he answered questions, to just try and get a little bit of a better hint into, was he, diverting from a subject? Was he overly compensating for a particular subject? However, the easy and long and short of it is this, right? Again, I spoke about dovish versus hawkish. Again, prior to the data coming out, when the data came out, we saw that markets sold off quite hard. And I mentioned to you guys that I'm not all too convinced on the sell-off. And I wasn't going to sell the sell-off because the data doesn't confirm, isn't in line with why that sell-off is happening for me. Immediately once he started speaking, we saw markets started rebuilding. Literally within the minutes of his, him speaking, markets started to rebuild. So that's indicative of two things, right? The first thing being is that markets just created a fierce sell-off, right? And I do also believe here there's greater forces at play than just retail and just data traders. There's certainly big Wall Street funds, banks. There's a bunch of people involved here to make these moves happen, right? I think it's quite plain and simple to see that the data that we got in terms of inflation, things are coming down. And I am curious as to why Powell didn't say, hey guys, listen, the data is still coming in, but you know what? They're still managing to curb inflation while not decimating the US economy, right? And I think that's something worth being proud of, right? And I think the markets will take that away as the final feeling. He came in dovish in the start. Towards the end, started to come in as, we will do whatever it takes to bring inflation down to 2%. And that's a difficult task they have, right? They need to bring inflation from where it is down to 2%, right? They need to almost halve inflation, right? And that's the difficult task. I think what was positive is that he mentioned, not any one of the members suggested a rate reduction this year, right? But he said nothing about next year, right? That's the first key takeaway. The second key takeaway is that they're only 50 basis points away from their target by the end of the year. So we know that between now and the rest of the year, there is going to be only 2 more rate hikes to be in line with their inflation fighting tools, or whatever the case, or what we wanted to call it. So we know that's at least on the cards. Between now and the next 2, there will be more. However, there's a bit of an opposite effect when interest rates are raised, right? And specifically looking at the tail end of the situation is that interest rates are raised. It's almost like, how do I put this into like a comparison? So in this case, where we're getting to the end or getting close to the goal of the Federal Reserve, they're going to raise interest rates. Let's say the next meeting is 25 basis points, and we'll get closer and we'll, as he says, we'll look at the data holistically and we'll figure it out together. But if they raise interest rates another 25 basis points, it has a very different meaning from raising it in the beginning, because you're raising it towards the end. So you're raising it and saying, we're raising it, but we're seeing positive signs. And should we see more positive, there might not be a need to raise it any further, right? And again, a lot can change between now and then. So looking at where we are now, right, the market's going to thrive off of any data that comes closer in line with what Powell is saying. So for future reference, right, and I'll talk about where the market's going to go. We'll dive a bit deeper tomorrow. If you are a Premium Plus subscriber, I'm going to break down all dollar-based markets. Apologies. So I'm going to break down gold, I'll break down USD, I'll break down the indice markets, I'll break down some FX stuff. I'll also break down crypto tomorrow in Premium Plus, right? I'll send through my charts, my forecasts, etc. However, what you need to know now is that looking at where markets are and looking at the fake outs, the bear trap we've seen to the downside, even with the data, right? Any data that supports the Federal Reserve's goals now, meaning if we see higher than expected unemployment claims, if we see higher than expected unemployment, or we see lower than expected new jobs being created, that's all going to point towards a weaker dollar, a stronger stock market. We should see that balance come back into play. However, you may be saying, okay, Dan, great, that's all nice, but I'm here now and I want to know what's going on. Let me show you guys something really quickly. Okay, so you right now, you want to have a look at what's happening. So this is going to be my big, I just want to remove the chat box quickly. There we go. So this is my whole play, right? This is what I'm waiting for. I'm not pulling a trigger on anything until I see this happen, right? And I want you to set up alerts on your phone, your PC, whatever it's going to take. But this is going to be absolutely key, right? And I can tell you now that if this level is broken, it's going to cause a massive amount of positive liquidity into the US city, into the stock markets across the board, right? Now, what am I talking about? I'm talking about that if markets recover this evening, which I think they will, and potentially even tomorrow, should we break and recover into two key zones, right? And you're welcome to rewatch this. You're welcome to draw this out, whatever the case may be. If you're in Premium Plus, I've already sent this screenshot to you, and I sent this in Premium Plus saying these are my key levels, and I'm monitoring these profusely, right? And there's a couple reasons for that. Was due to the liquidity, that liquidity bubble that we potentially going to go through. If US city is able to recover, right? And again, this is if you're using HFM, $34,180, so 34180. If we're able to recover to that level and break through, right, then we've averted this bear trap, and then we are in some serious bull territory, my friends, my family. Once we get above that level, we are past that CPI indecision, we are past the PPI indecision, and we are back into some serious bull territory. Right, looking at a 30-minute time frame, it means that the potential for a long continuation is extremely high should we get a recovery there, right? On a bigger time frame, you can go deeper and deeper into this. All I'm trying to say is that the opportunity here for a long, once we get over that level, is massive, right? We're talking about 6,000 to 10,000 pips. That's why, anything below this level, 2,000 to 3,000 pips, I'm not interested in, provided the data is not supported. But above this level, that's where I'm looking quite seriously. Now, should between now and tomorrow we not make it above this level, that might show markets overall are going to take this last little bit of a bull run, and they might want to start going into a consolidatory move, right? Meaning we might start moving, making lower lows, or just basically consolidating at this level until markets receive some sort of confidence that, allows them to go any further. However, above that level is going to be my key get in zone, and then I'll obviously have a look at where that is in correlation with US 100, where that is in correlation with something like gold too, right? Because again, I would need to see gold making some significant moves here, because gold will be the quickest indicator of a slowing down dollar. In addition to that, we obviously have the very immediate zone that the dollar is currently at, right? So having a look at the dollar index in terms of the current time frame, current day, you know, this spike down that we saw over the course of today, we would need to break that, and we need to break that significantly over the next day or two to guarantee any sort of significant lows or breaks of lows of the dollar. So you can see we made that massive push down, we've made that turn, but we're going to need to make a significant break here to have anything of value. Now, you will notice something else, right? The key eye among you will notice that we're starting to see, if you have a look at this market move we got this afternoon, we're starting to see what looks like almost these markets are correlating, but they shouldn't, right? They really shouldn't. Going down on a 15-minute time frame, right? There's the same move there that we're seeing on the dollar, and there's the dollar right there, right? So yes, albeit a little bit smaller, we're potentially looking at something like that. They're starting to correlate, and they shouldn't, and they're going to have to break that correlation, right? So the dollar index and US30 or indices and commodities should not correlate. They have an inverse relationship, an inverse correlation. So the second these break, right, I will look at a multitude of things, right? First thing being, does US30 and the dollar index break their correlation? Are they going inverted or opposites, right? If so, that will show me that markets come back to normality. And then where is USA 100 and gold in that mix of things, right? We got that push down this evening, just a bit of, you know, fear off that interest rate announcement. We got the speech that happened, pretty much retraced 100% of the level, right, already, telling me it's not just a little 78.6 or 88.2 retracement, telling me that this should be long term. So for me, again, I'm not doing anything until I start to see breaks over that level, 34,180. So essentially what I'm going to be doing is looking into tomorrow morning fairly early, right? I'm going to be looking into a couple key things, and there's just some bonus tips and tricks for you guys. Is 8 a.m. I'm going to be looking for any sort of stir up on gold, any break in small market structure, stir on gold that would show any bull momentum. And what you can find is if you catch that 8 or 9 a.m. break, that will generally be the trend for the day. So I'm going to look for that stir in momentum on gold at the start of the UK session open. That will sometimes be a precursor to general market moves. And then again, I've got some key levels that I'm looking out for, specifically US30, US 100. However, now this is behind us, right? Fed's made its statements, they've shot their shots. We've got the new interest rate for at least perceivable next month, right, until the next meeting. We've got CPI out the way, we've got we've got NFP, we've got all these items out the way. We're now moving into pure price action, right? So we allow the markets to figure themselves out, do what they're going to do, let the traps be completed, filled, and whatever the case may be. And from tomorrow, we should see normality in the markets, right? So we can get back to smashing out crazy trades throughout the day. If you're not part of Premium Plus, I don't know what you're doing, because there's never been a better time, right? We've just started things, just started the momentum. It's already off the hook, off the chain. It's going to keep getting better as we move from strength to strength. Outside of that, guys, listen, as always, thank you for joining us and investing in your time in the markets, understanding a little bit better. Until I see you guys all tomorrow, I should start fairly early in the morning with regards to signals inside Premium Plus, because I'm going to be watching for that market normality, as I said, on that London session open. However, this evening, as I said, that move down automatically almost completely retraced. As I said, you know, I'm not looking at chasing the sell, because I wouldn't have been surprised if we saw a complete recovery, which we did. Now we need markets to fully digest that info, right? Markets are going to be super confused across the board. That's going to be both on US30, both on the NASDAQ. NASDAQ actually recovered more than 100%. So NASDAQ's in a better position for a long continuation. And I'll basically compare US30 with NASDAQ long term. But basically the second Powell started speaking, the tech market basically recovered. Gold is kind of a little bit more sideways, contemplating its future in the market. So once all the noise is done and dusted, we basically move into pure trading, and we get into some fun trades, right? So outside of that, guys, have yourselves an amazing evening. As always, be safe, trade safe. I'll see you guys all tomorrow. You know the drill. Much love and goodbye.